Time for our weekly market review where we analyze the stock market to see if a correction or crash is coming. Because that's our job at Fallible, right? To watch the downside so that you don't have to. Risk control is always the name of the game. So first up in this video, we're going to talk about inflation because that is still the hottest topic right now. Then we're going to jump into the stock market to see what's happening there. And then we got a few stocks for you that we're looking at macro ops that you may want to add to your portfolio. And finally, we're going to finish up with a risk management technique that most people don't even think of. So you're going to want to stay for that. So let's jump into our research. And of course, it's coming from Macro Ops, our global macro research and consulting firm. The best research ever in the internet, which is a big statement, but I stand by it. So first up, let's talk about inflation. And as you know, all the inflationistas are back at it, saying that inflation is finally here because, of course, all the printing from the Fed and all the stimulus from the government, inflation has to come sometime, right? Well, these people have been wrong for years now, and they really haven't changed their framework for how they analyze inflation. They're still working off the old models, which is a problem in the market or really in any job where you're trying to analyze things. If you're not able to take in new information to change your models or your view of the world, you're gonna get screwed. The only way to be successful is to be constantly open-minded and changing. That's why this channel started out being called Fallible in the first place, because what does fallible mean? It means that you're able to take in new information, admit that you're wrong, and then change your stance so that you can make money, at least when it comes to the markets. But the people who constantly argue over macroeconomics, I just don't understand. It's not a religion, yet they treat it like it is. But anyway, at Macro Ops, we expect somewhat higher inflation later this year due to transitory effects, meaning that they'll be here this year, but then gone. And you can imagine why, because we're opening up, there's been a supply shortage, things like that should resolve themselves. Now, of course, it is possible that these transitory drivers are replaced with stickier cyclical ones next year. So while most of them should go away, there is a possibility of some of them staying around. So we do have extended higher inflation. But when analyzing something as complex as longer term inflation dynamics, it's pretty stupid to have high conviction predictions, which is what all these inflation people are saying, that inflation is definitely coming, and they say it every year and it doesn't come. And in this case, yeah, we think higher inflation is coming, but we have huge structural disinflationary dynamics. So the two forces working against each other, that's what makes it so complex, this whole thing, which is why you can't really be certain one way or another, which is another market lesson. And I know, oh man, so many market lessons today. But one of the best things you can do when you're speculating in the stock market or otherwise is accept that you don't know everything, that things are way more complex than you could understand. And having that humility is going to save you in the long run, because you're not going to be dogmatic about a singular position and put all your money on the line and be willing to lose it like an idiot, because you understand, hey, I could be wrong, so I might have to sell this and get out and manage my risk. Every successful investor knows they need to do this, but they also need to balance it with conviction, because you need conviction in something in the stock market, right, to invest. So as they like to say, it's strong opinions weakly held. So yes, have that strong conviction, but if new information comes in and says, hey, you're wrong, then have the humility to say, okay, let's change positions. Because the point in the stock market isn't to be right, it's to make money, which is much easier because you can switch your position until you're making money. T.S. Lombard talked about inflation in a recent post. They said the Fed, ECB, all the central banks, they could desire higher inflation all they want, and that would be a welcome shift from their deflation bias of the last 30 years. But unless there's a secular increase in R, and this is the natural rate of interest in the economy, they will struggle to achieve this outcome. And the problem today is that it's not entirely clear how those secular inflation forces will evolve. Demographics are changing, with an inflection point in the share of the population who are spenders rather than savers, because older people save less. But the militancy of the late 1960s and 70s is not going to return, and that's what everyone's afraid of, those high inflationary periods. So once again, things aren't so simple to just say that yes, inflation is coming. It's way more complicated than that. Now, this inflation question matters a lot because of how it impacts yields. So now we're moving into the stock market right now. What's going to happen to stocks? So the chief global macro strategist at Ned Davis Research found that since 2014, the NASDAQ 100's forward earnings yield, it's moved in lockstep with forecast corporate bond rates. What does that mean? Well, if the 10-year treasury yield rises to 2% this year, that in turn could drive the long-term corporate bond rates to 4.5%. And at that point, the NASDAQ 100 would have to drop as much as 20% to stay attractive, all else equal. If yields climb but the NASDAQ didn't move, this would indicate overvaluation. So this model correctly flashed warnings in 1987 and 2000. So this is tying back into what's been happening over the last few weeks between tech stocks stocks and rates. So you can see here, bonds have continued to plummet. Last Friday, they hit a new low. And this is bond prices, right? So as bond prices fall, interest rates rise. And this huge drop in bonds, which means a big jump in interest rates, that's what's been killing these tech stocks. That's why we had this bad route here. Because the way it works is that analysts on Wall Street, they plug in the interest rate into their valuation models for stocks. So if interest rates are higher, the actual valuation of a stock goes lower. So all these stocks in a higher interest rate environment, they got to get revalued. That's why they're falling. And if these bond prices keep falling, meaning interest rates keep rising, we could see these tech stocks fall even harder. And we'll talk about that more in a second here. Another interesting chart here is corporate management sentiment by industry. So this graph right here can tell us which businesses are looking good. Because if corporate management is bullish, that's a good sign because they're going to know way more about their companies and industries than any investor will. Realistically, as an investor, if you're lucky, you can know maybe 60% of the picture. Someone on the inside though, they're going to know a lot more. So given that, it looks like semiconductors, autos, and tech hardware, those currently have the strongest sentiment. So they may be areas that we should look into. Looking at the general market in terms of sentiment, the Bank of America bull and bear indicator is elevated, but still below an official sell signal. So it's at 7.2 right now. You can see right here, it isn't to that sell point yet. And you know how our sentiment analysis works, right? When people are too bullish, it's actually a bad sign. Because if they're really bullish and they put all their money into the market already, then what's left to push prices higher? Where if people are really bearish, that's actually a bullish sign because the same idea, they have a bunch of cash on the sidelines left to come in. So it's kind of like opposites when we do sentiment analysis. And of course, we got to mention that the stimulus got passed. So that is going to be real good for the stock market because according to a survey by Deutsche Bank, individuals between 25 and 34 with online brokerage accounts plan to use about 50% of their stimulus to buy stocks. And you guys remember what happened the last time the stimulus checks hit? The market took off because no one wanted to pay their rent. They wanted to put it all into the market. And that's what I used to talk about before. People were expecting to turn $1,000 into $100,000 in just a few months. No problem. Well, the second round is coming. And we've talked about a macro ops and on this channel multiple times that fiscal is the ultimate cheat code for the economy and markets. And what we mean by that is fiscal stimulus. So the government making policies to put money in the people's pockets. That is great for the stock market and great for the economy. And that's exactly what they're doing right now in conjunction with the Fed easing all the conditions. That's one of the reasons why we say this bull market still has a lot of steam left. So when you have a structural wave like that, you want to surf with it, not swim against it. But this time when the stimulus checks hit, it looks like there's going to be a wide dispersion in returns across the market. So you really got to pick the right stocks. It's not going to be the whole market going up again. So as we've been for the last few years, we are still bullish. And I love the comments down below these videos constantly accusing me of being a perma bear because they never get to this point of the video, do they? We've been bullish for so long while still managing our risk, but we also don't get complacent. That's why we analyze the market constantly, always looking for that turn. Did the information change? Is the risk different now? You got to constantly be vigilant for this type of stuff because the people who get complacent, those are the ones that get crushed when the market does turn. Now, with this market rebound happening, at least in the S&P, not so much in the NASDAQ over here, there's a few stocks that we're looking at. One of them is GM. Yes, crazy, right? You can see here they had a massive bear trap where it just fell really hard. And then all the institutional investors came in right here, as you could see, and pushed it back up. And now you're getting this bullish rip higher. So GM is a leader in self-driving tech and electrification. They're trading at just a 0.69 price to sales ratio. So if we could just apply a multiple half of Tesla's 21x sales, no, we're kidding, that would never happen. But we would be interested in playing this one on a pullback, probably back to this line right here. That could be a potentially good entry point. Next stock is BioX. So we originally talked about this stock when it was trading at $6.50, but it's done well since then. It's an Argentinian agricultural technology play. So we're really bullish on the whole agricultural space, and this chart looks pretty good. This company recently received regulatory approval for their proprietary drought-tolerant HB4 wheat. So this is the world's first and only drought-tolerant wheat. So does that mean it doesn't need water? Because that's amazing. But they got regulatory approval. So they have a new technology that could really send this stock price higher. You can see it's having a pullback right now, which is kind of the same type of pullback and pattern we were waiting for in GM. So it might be an entry point right here. Definitely one to keep on your watch list. Now I want to talk about a risk management technique that a lot of people don't consider. So back here we talked about the NASDAQ falling even harder if interest rates keep going up, right? Well, as you know, our Fallible strategy is focused on the NASDAQ because we're jumping into the highest momentum stocks. We got our TSI algo right here that ranks all the stocks in the NASDAQ by their momentum. And then every month we're rotating into the top 5 highest momentum ones so that we keep our money moving and in the strongest stocks. So obviously when the NASDAQ fell, that wasn't good for our stocks. We took a nice little hit. And now in our model, we are sitting in cash. And the risk management technique that a lot of people don't think of is exactly what I just said, sitting in cash. Because the truth is, cash is a position. You don't always have to be fully invested in the stock market. In fact, it's not a good idea to be doing that. Well, depending on your strategy. But in all of our models, even when there isn't a correction, we often do have a lot of cash because we're constantly taking profits off the table as our stocks climb higher. Now, of course, all of this falls under risk management because if those stocks turn around, we would have already grabbed some profits. And on the downside, we have less exposure at that point because instead of a 100% position in Tesla, maybe we have a 50% position. And a lot of people ask me, so then what do we do with all that cash? Well, that's the thing. Cash is a position too. And that's kind of where we get into risk adjusted returns. So even when I talk about how our system beats the market by a lot, usually every year, that's not even giving the full scope of how well it's doing. Because if you're invested in an index, to get the same returns of the market, you got to be fully invested the whole time. Where if you have a good system, you could be partially invested and have a lot of cash on the side so that your total exposure is lower, but on that smaller amount of money, you're making even larger gains than someone putting everything into the market. So just from that, by keeping more cash, you see how your risk is reduced, but you can still have bigger returns. And here's where our system tends to differ from other systems. We don't mind sitting in cash for long periods of time because look at this market right now. It is still super volatile. And this is how markets are going to be for a while because we've had such a long bull market, because technology has become such a big thing where everyone is on the news cycle. You got everybody investing. There's just a lot more volatility and a lot more craziness. So in these times, patience and the ability to sit on the sidelines for a bit, that is going to come even more in handy. So I said our system is a little different, right? Because a lot of systems want to be invested the entire time. So even as the index continues to fall, a lot of strategies continue to invest and take those losses. Where our system is fine just sitting there until things kind of look better. And yeah, sometimes you miss a rebound like this rebound right here. But what's the guarantee that it's going to keep going? We don't know. And yes, we are long-term bullish. We still think this bull run is going to keep going. But what's going to happen in the short term? Bonds here are still dropping. They're getting a little bit of a break today, but look what happened last week. We had a break all week until Friday when it collapsed again to new lows. So being a little cautious and staying in our position, which is cash, and having that patience, it pays off in the long run. That's why our equity curve looks like this blue line where the NASDAQ looks like this red line right here. Big difference. But hey, it's not easy to be patient because there is so much FOMO in the market, right? Everyone has the fear of missing out. Buy this, buy that. Oh, everybody's talking about it. So the more you can control yourself, the better you can be. And if you want to learn more about exactly how our strategy works, then make sure you check out our free training right here. I'm going to put a link in this video and down below in the description and comments. It'll teach you step by step exactly what we do and how that patience and cash management comes into play. So definitely check it out. It's the same strategy I use and all our Fallible members use too. And now is a great time to be learning it because we're all in cash. And the next deployment when the market turns around will come and you'll be ready. So click this right here to go watch that training right now. Learning how to use a good system really pays off, especially when markets get volatile like they're going to continue to be. So click this link right here and I will see you in that training.